Welcome to the Advisory Group's Retire with a Spending Plan workshop. Let me start with some introductions. My name is Brent Beverly. I'm the president of the Advisory Group. Also joining me on this today is Manny longtime wealth advisor at the Advisory Group, with our business partner, Chris Lee, the vice president of the Advisory Group. All three of us are certified financial planner practitioners and wealth advisors at our Diamond Bar branch. We like to say that we partner with our clients and believe that an educated client is our best client. While we'll always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with our clients any knowledge that can help you make an informed decision. We believe that the more you know, the more you're going to like what we do and how we do it. As a reminder, it's always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and of course, investment planning. And as a comprehensive financial services firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. And in this workshop, we'll be addressing and focusing on retirement and tax planning, as well as investment planning. Our agenda today is very straightforward. As you get into retirement, it's important to plan what you think you're going to need and where it's going to come from. Now, before we get into the workshop, I want to note that March 5th of this year, 2024, we covered a lot of important subjects in our 5 points for 5 years before retirement. For the most part, we will not be duplicating those important points here again. So we recommend that you also view our recordings of that session, which is available on our TAG website. Planning for retirement involves setting goals and a defined strategy towards achieving those goals. So whatever your plans are, make sure that you've made all the arrangements beforehand so you can live your retirement as confident as possible. Let's review 4 points that we'll cover in today's meeting. Point number 1, the 5 factors for financial independence. Point 2, the risks in retirement. Point 3, important factors including incomes and expenses. And point 4, creating your plan of action and getting it going. So let's explore this in more detail. To get into the meat of the presentation, I'd like to bring up our next speaker, Mr. Chinche. Manny?
Thank you, Brent. Let's first address what financial independence is. Now, when looking at retirement, we find that most people like to continue to do what they enjoy. Financial independence is the point in one's life when non-work incomes and other resources enable one to have the kind of lifestyle that they want, with that certain level of living standard for the rest of their life. We call this financial independence because even if you continue to work at what we would then call your hobby, it is not work anymore. It's a hobby because you have the luxury to walk away at any time. So when creating the plan for your financial independence, there are 5 variables that you can adjust. Now, we joke that you can change them or life changes it on you. Which choices are right for you depend on your individual situation, and there are no right or wrong choices, only those that are right or wrong for you. So be sure to discuss these choices with your advisor. So, ask for the 5 variables. The first is, how long will you live? This is the most difficult value to set. What length of time should you plan for? If you were to die tomorrow, financial independence is easy. The problem comes if you outlive your assets. As people live longer and healthier than ever before, it becomes even more important to plan for longer rather than shorter lives. When will you stop working? Now, this is a two-edged sword. The longer you work, the less time you have to spend money in retirement. Conversely, the less you work, the less time you have to put money away and the less time your funds have to compound to provide for your standard of living. When pension assets become available is often the time when people look to be financially independent. How much do you plan to live on? This is the largest factor in determining your need for financial independence. Because of the long time involved and the effect that inflation has on your standard of living, even a small change in the cost of living throughout your lifetime can make an enormous difference in the funds needed to provide for financial independence. How much do you have in the way of investments and how much are you adding? This is what most people think of when they look at preparing for financial independence. Some sacrifice now is needed to provide for your financial future. The balance that needs to be achieved is to not completely restrict your current lifestyle while still providing enough for your financial independence. Getting started and adding to your investments as early as possible can reward you when you start withdrawing the money to live on. And finally, what are you doing with your investments? Remember, it is not how much you make, it is what you keep and what you do with it. Look at the average after-tax return that you are getting on all of your savings and investments. For every dollar in the bank at a low rate of interest, you may need to have more dollars earning at higher rates of return just to balance at an average rate of return sufficient to accomplish your financial independence. With higher rates of return, typically comes greater short-term volatility. Successful long-term investing is usually a case of hitting consistent singles instead of occasional home runs. Also, please keep in mind, if you do not pick the values that are important for you, life picks them for you. Take charge of your own destiny and plan ahead. People do not get rich by making money, but by wisely managing the money that they have made. Retirees face many risks. Our first factor for financial independence is the question of how long will you live? This is your mortality risk. While passing away early is a problem, the big impact is living longer than expected, and that is what we call your longevity risk. People are living longer and healthier lives these days. How will your funds do if you are one of those who lives longer than most or even longer than you expected? Now, when Social Security was created, they picked the age of 65 at which to start payments, as relatively few people live that long. These days, we typically feel we are just getting started on the last trimester of our lives at age 65. Now, we separate this from your healthcare risk, which increases your expenses. What concerns most of us about healthcare is not that health problems that might kill us, but that needing healthcare almost always raises our expense levels dramatically. As we need care, especially long-term healthcare, which is not covered by insurance, how will we cover these costs and pay the bills while maintaining our enjoyment in life? So even without those personal risks, we face more general risks, such as inflation. In some places in the world, they are finding that deflation risks are just as toxic as inflation risks might be. These are not conditions that you can control, but they are risks that can dramatically affect your financial independence. Either with inflation or deflation, we believe it is prudent to base your planning on some likely rate of increase in your expenses. As for the last two risks, we're looking at investment-related risks. These come in a variety of forms. Market risk means that investments go up and down over time. We see it with stocks all the time, but even bondholders saw major downward moves in their bond values in 2022. And even what we call cash holdings has its own risks. The principal dollar amount of these holdings may not go up and down much, but after taxes and inflation, funds in the bank or in your wallet generally lose spending power every year, what we like to refer to as going broke safely. Now, is everyone familiar with Murphy's Law, which states whatever can go wrong will go wrong, and we like to add at the worst possible time? Now, we know markets go up and down, but over time we typically assume that returns will average a certain level. Order of return risk is when the markets all tank just as you start your retirement, meaning that your distributions are taking out a big chunk of your income base before you really get started. Withdrawal rate risk goes hand in hand with this. You may have heard studies that say you can pull out roughly 4% annually from your investments long term. The higher withdrawal rate, the less likely it is that funds will last. We give a lot of cautions if you expect that a 4% figure will last. Achieving the overall return that makes that possible depends on a lot of factors, with order of return risk being one of the crucial factors. Another point we like to know regarding your income and expenses is how long will your retirement phase be? If you're going to die tomorrow, go have a wild night because you made it. Congratulations. The truth is, though, that most people are going to live a lot longer than that, and perhaps longer than even they expect. So keep in mind that the retirement time frame starts before you actually retire. You need to prepare before you actually stop working. Now, retiring early may also reduce your income benefits long term. We see this most clearly when dealing with Social Security. Starting your Social Security income at age 62, when you first qualify, gets the income started sooner but results in a lower income for the rest of your life. The same calculation applies at any age before age 70 when Social Security benefits max out. That takes us to how long will your retirement last, especially if there's a couple involved. How is your health? If you have a serious illness, your life expectancy is a lot less than someone who is healthy. Think about your family history. Does your family have longevity? Is your 80-year-old father still taking care of your 100-year-old grandmother? You might plan for a longer retirement than someone whose family all passed in their 60s and 70s. Given the miracles of modern medicine, things that might have killed someone prematurely a few years ago can now be cured and a long life may be expected. Let's take a look at some statistics on life expectancy. I'm sure many of you are aware that medical advances and healthier lifestyles continue to increase longevity. So let's look at the bottom of this graph. A couple who reaches age 65 has a 50% chance of living into their early 90s and a 25% chance of living into their late 90s. So we can assume from these statistics that at least one person from a couple will live into their 90s. However, many people are not taking longevity into account when taking their Social Security benefits. Now, where you live may have a significant impact on your expenses. A major expense for most people is housing costs. Do you have a mortgage or pay rent? If you have your own place, even with the mortgage paid off, what about property taxes, homeowners association fees, and property insurance? What about utilities, maintenance, and repairs? We already discussed how other taxes may affect you, especially depending on where you live. Income taxes, sales taxes, registration, and many other ways that governments reach into your pockets. So even without housing considered, we still need other items to spend money on in our day-to-day lives. Dining at home and out, clothing, transportation, and purchasing supplies. As everyone who has paid the bills knows, the list seems endless. A lot of retirees look at their retirement as a chance to visit places they have always wanted to see. Many times that travel budget can be considerable. We find it interesting that many retirees figure their travel budget will be high for a while and then drop off as they age, but many of our senior retirees still love to travel if they're still mobile. The final expense that we want to note is medical. Not only medical insurance and Medicare, but also prescriptions, doctor visits, and other associated costs. We also want to note that many retirees will need long-term care. So what changes do we see in your spending in retirement? As with incomes, the key question is what changes? Look at each expense item. As your expenses flatten out, such as fixed mortgage payments, are they decreasing, such as child support, or maybe even going away when you stop doing things that you needed to do before? For example, we find that dry cleaning bills usually drop substantially when people retire. The problem is that most of your expenses are likely to be rising. Protecting your lifestyle from inflation or price increases is vital. How can this be achieved? Inflation is a big concern when you have a long period of time that you're dealing with. You may be aware that the Federal Reserve's target inflation is a low 2%. So even at 2% inflation, costs would increase by 50% in just 20 years. The equation here on your screen seems simple enough. Take your income, subtract the money you spend on your expenses, and if what you have left is positive, you have positive cash flow and you have achieved a successful retirement, right? Well, not so fast. We already looked at the many risks to retirement, but let's just focus here on the cash flow portion. We talked about inflation risk. Your expenses are likely to increase with inflation. Is your income increasing at that rate or better? Many pensions are fixed. That is why they will not go up over time. Even for those that do have an increase factor, will they increase at the same rate as your expenses? Now let's look at one of my favorite examples, Social Security income. It appears that Social Security payments will go up again in 2025, but we won't hear the exact figure until October 10th of this year. Now, we witnessed a huge 8.7% increase in Social Security income in 2023 after a year of very high inflation. We then saw a much smaller 3.2% increase in 2024 as the inflation rate started to decline. Since inflation is predicted to continue to decline, the initial 2025 COLA increase estimates are predicted to be even smaller. The Senior Citizen League initially said in February that 2025 COLA would be somewhere around 1.75%, but later this projection was increased to 2.63%. This latest projection is a bit higher than the 2.5% estimate made by the Congressional Budget Office. Again, we will learn the true figures on October 10th. At this point, our expectation is that benefits are slated to increase at that estimated 2.6% figure for 2025. That said, I ask you, look at recent times. did your spending increase by only 2.6% this past year? Now, we hear the questions regularly. Where will my income come from when my paychecks stop? How am I going to keep up with rising costs? These are the most common questions we hear as people prepare to go into retirement. Now, our income is obvious when we have Social Security, a pension, or an annuity that replaces 100% of our earnings, but usually this is not the case. If there is a shortfall, where are the funds going to come from? What sources do we have at our disposal for retirement incomes? In earlier times, many retirees had as their base income a company pension. These days, unless you're a government employee or involved with education, most retirees no longer receive that fixed lifetime guaranteed income. Instead, most of us expect to have income from Social Security. We're not going to cover the decision making that comes with deciding when to take Social Security, especially when to start your Social Security income to get the maximum benefit. But let me take just a minute to talk about some of the things we are seeing in store for Social Security. Each year for the last half dozen years, the Social Security trustees have delivered an annual report that reminds us that the Social Security Trust Fund is rapidly being depleted. They calculate that sometime around 2033 to 2035, Social Security benefits will need to be reduced by 20 to 25% across the board unless changes are made by Congress before then. Many people expect to be drawing Social Security income at that point and beyond. Now, beyond that are the funds that you have put away for yourself. The first place we usually look at are the pension plans that have been funded over our working years, our 401ks, our 403bs, IRAs, etc. If you do have funds set aside into these plans, don't forget to include your required minimum distributions into your planning. Now, as we have noted, your incomes need to keep up with your expenses, which are likely to rise with inflation over time. Check your different incomes to make sure. Are they flat or even decreasing and losing spending power to the rising costs that you will face, or are they in fact increasing? If they're increasing, are they actually keeping up with your needs? We will discuss this more in a minute. Now, one note that I want to throw in here, though, is that while Social Security income typically increases each year, our experience has been that it does not increase at the same rate as the expenses faced by retirees. The rate-based CPI, the Consumer Price Index, in our experience, runs below the costs actually faced by retirees. And that calculation does not include the expected reduction in Social Security benefits to come in about 10 years. Finally, we look at your other investments. Even if you have an outside source of income, you're likely to need additional incomes from your investments to help you live the lifestyle of your choice and to keep that lifestyle ahead of inflation. Remember on the previous slide, we included pension plan distributions as an outside source. In truth, pension plans such as 401ks, 403bs, IRAs, and other retirement plans are really investments that you need to manage to meet your goals for the long run. When it comes to long-term investing, there are quite a few concerns to be considered. Remember, there is no perfect investment. Instead, you need a strategy to increase your chances of navigating your financial future to arrive at your destination safely. Market concerns, especially as you start needing income from your investments, can be much more immediate than they are when you have time to let the markets work themselves out. What sort of portfolio changes can you make to help ensure an enjoyable retirement? History teaches us that short-term investments often have lower volatility in the short run, but tend to go broke safely or lose spending power over the long run. Interest rates on these investments can change as the world economic environment changes. Longer-term investments, on the other hand, face downturns. Crashes and corrections are normal and not predictable, and so diversification can help. This session is already too long to spend much time on investment education, so if you want additional information regarding investments, please view the educational videos on our website. Now, we will discuss a strategy to handle the withdrawal process here in a couple of slides. As you approach your retirement, consider adjusting or reallocating your portfolio and evaluating other income-producing and growth investments. As you put that into practice, be sure to keep in mind that your time frame is not the date of your retirement. Your time frame is really likely to be decades after that retirement date. Now, here on your screen is a graph of the S&P 500 and how it has performed since 1980. As you can see from this view, those investors who focus on a long-term strategy were historically rewarded with significant returns despite all of the various dips in between. Now note in the heading where it says as of September 27th, 2022. Why would we pick that particular date? Well, September 27th, 2022 was a low point of the market in 2022, which was a poor market year. What has the market done since then? Well, it has for the most part gone up since then, but even at that low point, it brings up the notion that those investors who focused on a long-term strategy were historically rewarded with significant returns. This chart would look even better if we took it to the market values of today, which are significantly higher than what we're showing in this chart, as 2023 and 2024 have been fairly good years. Now, the concern is that when you're withdrawing funds, the effect of market downturns can be devastating to your portfolio. Again, look at all those downturns along the way. So how can you protect yourself? Here's a concept that may help. This method that we refer to as the 3-bucket method sets up retirement withdrawals and helps us visualize how our retirement income will be managed from a liability standpoint. Withdrawals to support our lifestyle is a liability we commit to with our investment portfolios. Now I'm actually going to cover these in reverse order, starting at the bottom, that green bucket, which is the short-term or immediate bucket. We can refer to this as the spending bucket. This bucket is where you want to be pulling your income from, so it will contain largely cash and cash equivalents, as well as short-term investments that are not subject to market fluctuations of much significance. Now, typically, we expect to hold roughly a year's worth of expected withdrawals in this account. When the markets are down, you only take income from your cash reserves bucket, the short-term bucket. You're not selling more volatile holdings at a low price. As markets recover or begin to look more normal, regular transfers from the next bucket replace funds that have been taken from that short-term bucket. Now these come from the second bucket, marked here in blue, which is the intermediate bucket. We refer to this bucket as a second-tier bucket. This bucket will focus on investments that are less volatile, which are oftentimes fixed income investments and income with growth equities or protected assets. The time frame on these investments is typically 3 to 5 years. The primary goal here is to keep up with inflation while protecting the downside. That takes us to the final bucket, the long-term bucket, here shown in red. The investments in this category are designed for long-term growth. And since there are the other buckets to cushion any downturns, the goal on the long-term bucket is to grow as much as possible over a period of over 5 years to provide the resources for inflation-protected incomes in the long-term future. Now, this 3-bucket strategy is designed to provide a bit of a safeguard against normal markets' ups and downs. When the market is down, you rely on the short-term bucket to draw the funds you need. Assuming the markets go up over time, as the markets go up, you may draw from the blue and red buckets to replenish the spending bucket. You are then able to weather another downturn when that happens. As we noted earlier, market downturns are normal but not predictable. This tool gives your investments a way of handling the downturns. You never want to be in a position where you withdraw from the wrong buckets at an inopportune time. Now, in addition to the risk levels, where to draw the funds for your retirement incomes is also often dictated by the taxation on the distribution. Our focus is on what you get to keep after taxes are considered. As we noted earlier, it is not what you make that really matters, it is what you get to keep after you have paid your taxes that matters. Now, there are multiple types of incomes when we deal with your taxes. The first ones are those we are probably most familiar with, ordinary income. We also include in this category short-term capital gains, as they are also taxed at the highest tax brackets. Next, we look at long-term capital gains. These are taxed at lower tax rates. For example, for investors who are in the lower 2 federal tax brackets, the 10% and 12% brackets, long-term capital gains are federally income tax-free. Even for those in the top tax bracket, currently 37%, long-term capital gains are taxed at almost half that rate, at only 20%. Qualified dividends are treated the same way for taxes, and keep in mind that state income taxes are different. We may also have incomes, especially from municipal bonds, that can be tax-free. And if they also happen to be tax-free for the state that you're in, we call those double tax-free. I want to note here that if you have an investment that has a basis in it, your basis will be tax-free when you pull that out as well. So let's explain basis very quickly. If you purchase an investment directly, say a share of a stock, and you buy it for $100, that is your basis in the investment. If you sell it later for, say, $150, your gain in the amount over your basis, in this case, is $50. The basis is returned to you tax-free. That gain, That $50, if you held the stock for less than a year, would be considered a short-term capital gain, and if you held it for more than a year before you sold it, the gain would be considered a long-term capital gain and taxed at a lower tax rate. Finally, we include deferred gains. In our example of the stock, you defer your gains or losses until you sell the stock, but may be taxed on dividends along the way. In IRAs and other pension accounts, you typically compound your earnings, including dividends and interest, tax deferred until you pull them out. We also need to remind you of required minimum distributions for your retirement income planning. Once you reach your required beginning date, you need to start taking a required amount every year, whether you want it or not. There may be planning opportunities to take incomes earlier at lower tax rates, all part of the retirement planning puzzle. And to cover our final section, allow me to turn it back over to Brent Beverly. Brent?
Thank you, Manny. That was a lot of detail to cover, and you did a great job. We'd like to remind our investors of the 4 things that help you approach your investments with discipline and focused direction. First one, of course, is your risk tolerance or risk appetite. By this, we mean how much risk can you take, or better yet, how much can you afford to take? Your time horizon, or the amount of time you'll want to be invested in any situation, which can help you determine your entry and exit points. Your retirement is likely measured in decades, not just a few years. Your behavior. Market volatility is a part of the investing experience. This can create anxiety and stress when volatility occurs. Do you know how well you can emotionally endure the potential ups and downs of your investments? We want you to stay focused on your overall strategy. Don't get caught up in emotional investing. Are you looking for something that doesn't quite fit in your overall strategy? Perhaps the media is influencing you to take a rash or impulsive direction on your investments. We'll help you overcome the short-term fear or greed emotions that might distract you from your long-term approach to investing. We want your holdings to be consistent with your overall strategy. Panic can create more risk and potentially cause setbacks in your goals. We believe that long-term success comes from maintaining your overall strategy. Now that said, past performance is not an indicator of future performance. 2024, as an example, has already been an interesting year, and it's not over yet. We stand firm by our mantra of proceed with caution. And for this workshop, I would actually say this is even more applicable if we change the last word in this text to retirees instead of investors. Please remember, we'll be watching all those areas of the economy and financial markets which we feel may affect our clients. If emotional investing triggers hit you, we're here for you to help you stay with your long-term investment strategy. Now, here are some key points that we hope you'll take away from your review of investing in retirement. Number 1, what we just stressed, caution is still the principal notion for investors. Inflation, while it's slowing down, continues to be a concern. Interest rates are likely to change. Market downturns are likely to occur multiple times in the future. As a reminder, long-term investing is a key strategy working with equity markets. And as always, we're here to help you. We're here to help you make it through this. So let me bring our agenda back up. We've looked at the first point, the 5 factors of financial independence. Point 2, some of the risks that you're going to face here in retirement. We then focused on point 3, how to help ensure that your incomes and investments will cover a lifetime of expenses. Let's move now to point 4, creating your plan of action. For each of us, our plan of action is distinct as our lives. Your plan needs to fit your needs. The plan needs to be tailored to your situation and your resources. So take the time to picture what retirement looks like for you. We believe that before starting any journey, having a map of where you're going and how you plan to get there can pay great long-term dividends and make your journey far more enjoyable. Taking a detailed look at your expected expenses in retirement can provide you with a more accurate target. Understand what incomes you'll have coming in and when. And part of this planning, of course, is the tax planning to help you keep the most after your taxes. So meet with your tax advisor. Understand what your tax picture is likely to be now and in retirement, and whether action should be taken now to prepare for your retirement. Make sure you develop a plan for handling health care, including long-term care costs, through your retirement through the rest of your life. And focus your investment portfolio to provide long-term income, which is tax-aware and which can help you protect against inflation. And as always, nothing happens unless you take action. Don't let retirement sneak up on you. Take action ahead of time. Now's the best time. We've covered a lot today. So what can you expect from us at the advisory group? We like to use the analogy that retirement is taking the ship on a cruise of your life. So what kind of ship are you going to have? A racing boat, a luxury cruise, a tugboat? Where do you want to go along the way? Do you want to just sit in the harbor in your boat, or do you want to visit places along the way? Now, in this analogy, we want to be the captain of your vessel. You can replace your captain at any time, but while we are your captain, we'll bring our experience and abilities to help ensure that you arrive at your destination safely. One of our main focuses is to review changes for our clients on an ongoing basis. In our example of designing a roadmap to get you through retirement, well, we can't control the weather. We can't control what you're going to find along the way. What we can do is help you to adjust to new situations to get you through as safely as we can. So you can expect regular communications. You can expect more frequent discussions. And you can expect that we're continuously reviewing economic, tax, estate, investment issues for our clients. We then work to summarize what's important for what our clients need, and then do that regular communications that we discussed above. So look for a lot more communications from the advisory group coming. We also had an end of the year planning newsletter just come out. Right? There's one. We have an investor update scheduled for October 23rd. And then we have an end of the year tax planning webinar scheduled for after the election. With the election hopefully settled by our webinar date, you'll see and hear additional communications about the 2025 tax sunset. There are likely to be actions that need to be taken before the end of the year, so be sure to tune in and learn what might affect you. Of course, there are important disclosures. Please pause here and take a read of these. We're thankful for the opportunity to assist you and your family with your financial needs. So remember, at our firm, clients come first, and your health and well-being is always our highest priority. If you need to get in touch with us, please do so. Here's the communications. Here's our tag team, recently updated for our newest team member. So if you have any questions, reach out to us. We're happy to help. I also want to thank you for attending. Have a wonderful year. Best wishes.